Wherever you may be. It is now 12 o'clock, it's probably a little after 12, 12:07 here. And I have taken a list of the items that you have submitted to go over for taxation regulation. And I think you'll find this very, very helpful, because these are the areas I find that do give people trouble. And the first one we're going to start with today is on page 3A5. And I didn't tell Carrie in advance, so I have to get it to go to 3A5.
Just a moment.
And there's the Y for yellow. No, that's my name. Okay. And by the way, I think you're going to find by listening to these, once again, listening to these seminars every Sunday, it's got to help you. But after you go over this, you got to make sure, all right, that you study this stuff. Now, once again, if you do not have a book for regulation, all right, it's harder to study. But if you need to buy a book, the book is available to you. And I think it's something like $65, $70 plus shipping. But anyway, just call Sonny if you need a book, all right? 301 is the phone number in Maryland, 874-4900. And I always press 6 for him. All right, 874-4900, area code 301-6 for Sonny, and I'll give you a book. All right, now, Carrie, can you just move the number 2 up a little? Taxable and non-taxable, you see that? All right, keep moving up, please.
There you go.
And let's just go up to where it says, all right, the blueprint. Calculate the realized, recognized gain, deferred gain on like-kind exchanges, okay? All right. Can you move up to that point? Number 1. See what number 1 is, like-kind exchange? All right.
Yep, it's coming.
Take that to the top.
I think we're just a little bit delayed.
Okay,
so,
there we go. All right. Anyway, a like-kind exchange is a swap. That's really what it is. And you're swapping, all right, property of a like kind. Now, remember, it only applies to business property. It doesn't apply to property that you own personally. That means non-business. And remember this, starting January 1st, 2018, Tax Cuts and Jobs Act says that personal property is no longer subject to like-kind exchange rules. So basically, the only thing that is subject to like-kind exchange rules are rental real estate or real estate used in a trade or business. So please remember that. Real estate used in a trade or business for real estate used in a trade or business, all right, is considered like kind, all right? But personal property used in a trade or business is no longer subject to like kind rules. Now, the blueprint says calculate the realized gain, recognized gain, and deferred gain on like kind property for federal income tax purposes. Now, the next thing under the paragraph that says rental real estate is considered to be trade or business, all right, it doesn't have to be just rental real estate. It could be an office building. That's also real estate. So I could exchange an office building for your rental property, because rental property is considered business property. And also, if I have investment property, that's also considered business property. So please remember, like-kind exchange rules apply to real estate transactions, but only for a business. Now, the next thing says specifically, like-kind exchange rules will not apply to the following. It doesn't apply to inventory. You can't swap inventory and have a non-taxable event, all right? You can't swap investments in stocks, investments in bonds, or investments in any type of notes. Also, if you swap an interest in a partnership, I have an interest in the ABC partnership, you have an interest in the DEF partnership, all right? If we swap it, it's not a like-kind exchange. There might be some taxable gain, all right? Also, here it is, property held for personal use, all right? Property held for personal use, that would be non-business personal property. So if I have a car that I don't use in my business and I swap it with another car, all right, that you don't use in business, or if you use it in business, it's still not subject to like-kind exchange. So property held for personal use and also personal property used in trade or business is no longer subject to the like-kind exchange rules. All right, now, let's move on to page 3A6. All right, 3A6 on the top. And it says, all right, in these questions dealing with like kind exchange, someone may receive boot or gave up boot. Now, boot can be cash or, all right, it can be not like kind property. For example, if I exchange real estate used in a trade of business for real estate used in a trade of business, and you give me your boat. Now, the taxable exchange is what? Real estate used in a trade of business. But if you give me a boat, that's not part of the exchange. So therefore, that's considered unlike property. Unlike property, that boat is considered boot. All right. Now, what do you take for the boot for the boat? The boot for the boat. You take the fair market value of the boat when you're looking at the boot. And also remember this. All right. If you receive cash, that's boot received. If you pay cash, that's boot paid. And here's another one, the second paragraph from the top. Another common form of boot would be liabilities assumed or relieved of. All right. If the other party assumes your liability in exchange, then that taxpayer has boot received equal to the liability relieved. So if I give you a piece of property, real estate used in trade business, and it has a mortgage, and you assume my mortgage, all right, to me, that's boot received. Now, if I take on a new mortgage, that's boot paid. All right, so please remember that. Now, this one here, calculate the realized recognized gain disposition for federal income tax purposes. All right, ignore that right now. It's actually, I think it has to be taken out. All right, now we're going to go, if you would move up, Carrie, let's look at an example of a like kind exchange question. All right, can we move up to the top a little more? Stop. There we go. All right, now what you're going to do is this. You're going to calculate the realized gain. Now remember, there could be a realized loss, but in a like kind exchange, there is no recognized loss. But in a like kind exchange, you can have some of the realized gain as recognized gain, but you never recognize loss in a like kind exchange. So let's look at the facts here. Taxpayer A owns land which used in the taxpayer's business with an adjusted base of $22,000 and a fair market value of $25,000. Taxpayer B owns land which is used in taxpayer's B trade of business with an adjusted base of $30,000, subject to a mortgage of $6,000 and a fair market value of $33,000. Taxpayer A and B exchanged real estate investments. Taxpayer B paid $3,000 in cash to taxpayer A. Taxpayer A is assuming taxpayer B's mortgage. The realized gain or loss, the recognized gain or loss, and what's the basis of the new property from taxpayers A or B. Now, the first thing you're going to do is you're going to show the proceeds, what you are receiving. Well, taxpayer A is receiving property from taxpayer B at its fair market value. All right, if you look at the facts, all right, the fair market value of the property of taxpayer B's property that A is receiving is $33,000. Also, all right, taxpayer B is paying $3,000 cash to taxpayer A. So that is considered boot received. All right, so the total amount received is $36,000. Now, what did you give up? Well, you gave up the following. All right, if you look at the thing with the $6,000, it says taxpayer B, all right, has property, all right, subject to a mortgage of $6,000, and taxpayer B assumed, all right, taxpayer A assumed taxpayer B's mortgage. Now, when you assume someone else's mortgage, that's considered boot paid. All right, so taxpayer A assumed taxpayer B's mortgage. All right, that is boot paid. And also, don't forget, you subtract your basis of the property given up. The basis of the property given up is $22,000. So once again, all right, you take everything you receive at fair market value, all right, and also you subtract everything you gave away. Now, if you assume someone else's mortgage, then what happens? All right, then you what? Gave away, all right, $6,000 of cash. All right, here you also gave away your old asset at its basis. So therefore, if we look at this, we have an amount realized of 36,000 and the amount given up of 28, which means that we have a gain realized on the exchange of 8,000. Now, please remember this with this rule. The recognized gain is the lesser of the realized gain or the boot received. All right, well, the realized gain is 8,000. The boot received is 3. All right, the recognized gain would be what? $3,000. That's the recognized gain. Now let's look at taxpayer B. Taxpayer B received, all right, land from taxpayer A. What was taxpayer A fair market value of the land? 25,000. So B assumed that 25,000. Also, all right, B had property basis subject to a mortgage of 6, and taxpayer B, all right, actually did what? So again, taxpayer A assumed taxpayer B's mortgage. So therefore, and when someone assumes your mortgage, it's what? Boot received. So there's 6,000, boot received. So the total amount received is 31,000. Now, what do we have for what you gave up? Well, according to this, taxpayer B paid 3,000 cash to taxpayer A. That is boot paid, all right? Secondly, all right, then you subtract taxpayer B basis in taxpayer B's property. Taxpayer B's basis in his property is what? All right, it is 30,000. So we add the following. We received 31, subtract 33. We have a loss of 2,000. The realized loss is 2,000. The recognized loss is 0. All right, so if we can move down a little on this, move up, I'm sorry. All right, gain or loss recognized on the exchange. It says, though the $8,000 gain is calculated as realized for tax purposes, the gain is only recognized to the extent of lesser of the realized gain or the boot received. So for taxpayer A, the gain recognized is lesser of 8,000 or the boot received of 3. So therefore, taxpayer A will have a recognized gain of what? $3,000. And because taxpayer B has a realized loss, the entire 2,000 realized loss is postponed, all right, and will impact the basis of the new asset received. All right, now let us look at how you calculate the basis of the new property. All right, now if we would move this up, all right, now just think about this 1 second, all right? And by the way, it would be nice if you had a pad of paper with you, okay? That's gonna help tremendously. All right, now, how do you calculate the basis of the new property? Well, taxpayer A, all right, you take your old basis of your property, you add the gain recognized. Now, why do you add the gain recognized to the old basis? Because what happens is, if you're recognizing a gain by stepping up your old basis, when you sell that asset, all right, you won't be recognizing the gain twice. So it's old basis plus gain recognized, all right? Now, you add to that boot paid. And you subtract from that any boot received. All right, so let's see what we have here. All right, the old basis is what of taxpayer A? All right, if you look at it, it was 22,000. Now, A, all right, recognize the gain of 3,000. We'll add the 3,000 to the 22,000. All right, now, what was the boot paid? All right, well, A paid B $6,000. All right, so that's 6,000. And also, A received 3,000 from taxpayer B, 3,000. Boot received is a negative. Now you wonder, how do you remember boot paid is a positive and boot received is a negative? Well, if you look at boot paid, paid starts with the letter P. So boot paid is a plus. All right, boot received, received starts with an R. So boot received is a reduction. All right. So there's the basis of the new property to A. All right. You do the same thing for B. All right. Now let's move on here, Carrie. All right. The 3A7. Move all the way up. All right. A good way to remember how boot is treated when calculating basis. Boot received begins with an R. It represents reduction of basis. Boot paid begins with a P. All right. That's plus with P and represents an addition to basis. All right. Now, this is the next point. In an exchange, if taxpayer A and taxpayer E assume each other's mortgages or liabilities on the exchange, the liabilities must be netted to determine if the exchange of liabilities results in boot paid or boot received. When the mortgages or the debt are netted and the result is net boot received, this is an addition, all right, to create the gain recognized. But if taxpayer A nets the mortgages, all right, or debt, and that results in net boot paid, it doesn't affect the gain or loss, but will affect the basis of taxpayer's A new asset. Now, what the heck does that mean? All right, let's go down here to the example on page 3A. What did I say? 3A, which page are we on? We're on 3A7. All right, let's go to, all right, the bottom of 3A7. Let's look at the example here. All right, now, it says taxpayer B assumes taxpayer A's mortgage of $8,000 in a like-kind exchange, and taxpayer A takes on taxpayer B's mortgage of $6,000. All right. Now, it goes on to say that taxpayer B's adjusted basis of the old investment real estate transferred is $40,000, and the fair market value is $45,000. Taxpayer A's adjusted basis of the old investment real estate transferred is $30,000, and the market value is $60,000. All right. Determine the realized gain, the recognized gain, all right, in addition to the basis of the new real estate acquired by taxpayer A. All right. Now, you must assume the real estate is trade or business. All right. So this is what we do. First of all right, we take taxpayer A. Now, what did taxpayer A receive? He received B's property at fair market value. If you look at B's property, all right, what is B's property at fair market value? And the answer is $45,000. All right, now, what about the boot received or paid? All right, now, B assumed A's mortgage. All right, now, what was A's mortgage on the property? All right, A's mortgage on the property, let's read the information. All right, B assumes taxpayer A's mortgage of $8,000. There it is. So if taxpayer B assumed taxpayer A's mortgage, that is boot received to taxpayer A. So the amount realized is $53,000. All right. Now, can we just move up a little? I don't know how we can do this. Okay. All right. Now, let's look at, I don't know if we can keep this up here. All right. All right. Let's just move up a little, leaving out the facts if we can. I just want to, yeah, okay. Ooh, all right. Well, anyway.
Yeah, it doesn't. Unfortunately, it doesn't work out for us with
all right,
these,
we'll explain this. All right. Now, if you go and you say, well, what did taxpayer A give up? All right. Well, first of all right, taxpayer A assumed B's debt of $6,000. When you assume someone's debt, that's boot paid. All right. And also, all right, we're going to subtract always the adjusted basis of A's real estate given up. All right. So what we have here is this. All right. We have total received. Carrie, can we go up just a little ways and show the total amount received? Bottom of page 3A7.
Yeah.
Have to adjust. All right. All right. All right. Total received is $53,000. Let's go back to the bottom now. All right. Total given up. That's the next page, 3A8. All right.
Yep.
53 minus 36 gives you a gain realized on exchange of 17,000. All right. Now, what do? Well, let's go back here. All right. Did taxpayer A assume any boot? Back of page 3A7, Karen. Oh, that's good.
Yeah, so
Right.
we actually had a great comment come in from Cynthia suggesting that I just reduce the size of the view. So that's what I've done.
Cynthia, you're replacing Carrie. Thank
Sounds
you.
good.
No, Carrie, I'm just kidding. All right, so here we go. All right, let's look at the mortgages here. Taxpayer A, all right, B assumed A's mortgage. That $8,000 is boot received. All right, so you take the mortgages, boot received of $8,000. Now, A took on a new mortgage of B of $6,000. If we net the mortgages, all right, we have net boot received of $8,000 and net boot paid of the mortgage of $6,000. If you net it, the mortgages show a net boot received of $2,000. So remember I told you, if you have a net boot received, all right, as a result of netting the mortgages, then you add that to any other boot received. Well, taxpayer A did not have any other boot received. In fact, it's zero. So therefore, all right, what is the recognized gain? It's the lesser of the realized gain. We said the realized gain was how much? 17,000, all right? Or we net the mortgages and it gives us a net boot received from the mortgages of 2,000. So the gain recognized is $2,000, okay? All right, now.
So we had a question come in on this.
Yes.
In this example, if taxpayer A gave cash of $10,000 to B, would the basis of the new property be increased?
Repeat that question.
In this example, if taxpayer A gave cash of $10,000 to taxpayer B, would the basis of the new property be increased?
Whose basis? B?
That they don't say.
Well, we have, whose basis are we talking about? Whoever asked the question, whose basis are we talking about?
A.
Right? A. All right.
Yep.
Well, if taxpayer A gave taxpayer B cash, that's boot paid. All right. Now, right? Now, taxpayer B received that cash. All right. That would reduce taxpayer B's basis. Does that make sense? Did I say that right? Person who asked it? All right. Yes or no? Do you understand that?
They haven't responded yet.
Yes, thank you. Okay.
Okay, perfect.
All right. Good. All right. Now let's look at taxpayer B. You have to look at the facts. Don't worry about it. All right. If you look at taxpayer B, he's getting property from A, having a fair market value of A to B of 60,000. Also, A is assuming B's mortgage. All right. If A assumes B's mortgage, then B is being relieved of his mortgage, and that would be boot received to B. So the total received by B is 66,000. Now, what did B give up? All right. Well, all right. B assumed A's debt. A's mortgage was 8,000. So if B assumes a new debt, that's boot paid. So that's a reduction of what you received. And always subtract the adjusted basis of the real estate. So what we have here is total amount received of 66,000, total amount given up of 40. Did I say 540,000? I meant just the basis is 40,000 of the property given up by B. I apologize. So total amount given up by B is what? $48,000. All right. You received 66,000, gave up 48. Realized gain is 18. Now let's see if there's any recognized gain to B. B did not receive any cash. That's not any boot received. Now, if we net the mortgages, all right, let's see what happens to taxpayer B. Taxpayer B has a what? Mortgage or a boot received of 6,000. All right. And then on the new mortgage, which is boot paid, he has 8,000. So if you take the boot received of 6,000 and the boot paid of 8,000, that gives you a net boot paid. All right. Net boot paid does not add to the recognition of the gain. So there is no net boot received. You didn't get any cash, you net the mortgages and the boot paid. So the recognized gain will be zero. Will be zero. All right. Now, let's get the basis of the new property. We'll just take A, for example. All right. How would you get the basis of the new property to A? All right. Now, first of all, you would take A's old basis, All right, what's A's old basis? All right, I'll tell you what. All right, it's on the actually bottom of the page. But I'll tell you what. Please calculate the new basis to A of the property A received from B. All right, just take a quick second, see if you can calculate it. All right, now something you have to memorize is this. Old basis plus any gain recognized, all right, plus any boot paid minus boot received is the new basis, okay? All right, now let's see what we have here. What is the basis of A's property he gave up? $30,000. Now, did A have any recognized gain? Remember that? Yes, A had a $2,000 recognized gain, all right? We always add the recognized gain to the basis to step up the basis. And then we look at the other thing, all right? Now, taxpayer A had boot received of $8,000. The boot received of $8,000 is a what? Boot received R is a reduction. We have a reduction of $8,000. And also, all right, A took on B's debt, that's boot paid. So the $6,000 boot paid would be a what to the basis? A plus of $6,000, all right? So therefore we have 30,000 plus 2, all right? And we add the what? The $6,000 for the boot paid. And also the boot received is a minus 8. The basis to A is $30,000. All right, you want to try the basis to B? I'll give you a second, try it. Got very quiet. Please type your answers here. Very good.
That's just me encouraging everybody when they come up with something.
38,000, you're coming up with the basis for B. That is incorrect. Try it again. Anybody else? All right, here we go. All right. I want you to tell me, you're going to walk me through this. All right. What's your starting point to figure out B's new property basis? What do you take? All right. And the answer is you take what? All right. The basis of the asset given up, right? All right. Now, what was B's basis in the property? What's his old basis? 40,000, right? Good. Now, is there any gain recognized? No. So we don't add any gain. Now, we do have A assuming B's debt, all right? That would be what? Boot received to B. So you would subtract $6,000. And remember, B took on A's debt. That's boot paid. All right. So what happens? All right. You have 40,000 minus 6 plus 8 should be $42,000. All right. Does everyone have that? You having trouble with that, anybody? All right. Now, let me just see here one second. All right. Let's try a multiple choice here. So maybe, let's see, according to this, it's Q13. All right. Let me just get that question. I wasn't going to go over it before. All right. But let's do it together. All right. Q13. Q13 is on page, bear with me a second. It's on page MCQ 3-2. All right. And let me see if this is the one I want to do. I'm looking for one with boot. Okay. And that's not the one I want. What did I say, question 13?
Yep.
All right. No, I don't want to do that one. Okay. Good. Okay. All right. What is the taxable gain? Let me see here. Hogan. All right. Let's do question number 17. 17. All right. Let's do 17.
Yep.
Try that on your own. 17. All right. 17.
Should be on the screen
Read
now.
it. Hogan exchanged a building used in a trade of business for land used in a trade of business from Baker that has a fair market value of $80,000. Hogan also received cash of $1,000. The building has an original cost of $100, all right, minus depreciation taken of $30,000, all right. Baker assumed a $2,000 outstanding debt on the building. What taxable gain should Hogan recognize? All right, see if you can figure that out. Let's see some answers coming. It says say adjusted basis is plus gain plus boot paid up to the basis, subtract loss. No, don't subtract loss, okay? There's no loss recognized. Anybody else got an answer? I think we went. I guarantee you, all right, what is that from? All right, what letter is that? You got to give an answer, all right? For number 17, is it A, B, C, or D? A? Well, that's not what it says here. All right, are you ready to do this? B is the correct answer. B is the correct answer, okay? All right, now, let's look at our calculation. First of all, Hogan received property, all right, having a fair market value of $80,000. All right, now also Hogan received cash of $1,000, and also if Baker assumed Hogan's mortgage, that is boot received to Hogan. So we have the following received: the fair market value of the property received, 80, plus the cash received, plus the fact that Baker assumed Hogan's mortgage of $2,000. Total received is $83,000. Now we subtract the items that were given up by Hogan. All right, Hogan gave up his basis of the property. Now they gave you the cost of $100,000. You subtract the $30,000 depreciation. So the basis of the item given up by Hogan was $70,000. Now Hogan has a realized gain of $13,000. Now is $13,000 the recognized gain? No, because the recognized gain is the lesser of the boot received. The boot received is the cash received of $1, and the fact that Baker assumed Hogan's mortgage of $2. The boot received is $3,000. So we take the lesser of the $3,000 or the realized gain of $13. Which one is less? $3,000. All right. So $3,000 is answer what? All right. It should be answer B. Answer B. Now, what's the difference in realized and recognized gain? Realized gain is just an accounting gain. You take the difference between what you received minus what you gave up. The recognized gain is how much of that realized or accounting gain that's recognized for tax purposes. Okay? All right? Does everyone see this? You got it, you know, they have been giving problems on like-kind exchanges for a long time. All right? And people have trouble with it. But, all right, if you know what I just did, you shouldn't have any problem, okay? All right, but just give me some idea. How many people still do not know what the rules are for like-kind exchange? All right, if you would. Anybody? Just tell me. Don't be ashamed, okay? All right.
So
oh, you have trouble?
Yep.
Paul has, all right. From Deanna, I get it now. From Elliot. Paul, I don't know, what don't you understand? All right, still very confused with netting mortgages. All right, if you net the mortgages, someone assumes your mortgage, that's boot received. All right, if you take on a new mortgage, that's boot paid. Now what happens is this: you take the netting of the mortgages. If the mortgage that was boot received exceeds the mortgage that you took on the new mortgage or boot paid, if the boot received exceeds the boot paid, netting the mortgages, that is considered an addition to create gain, okay? But if you net the mortgages, someone assumes your mortgage, that's what? Boot received. You take on a new mortgage, that's boot paid, all right? If you net it and the new mortgage exceeds the basis of the mortgage that was assumed by the other party, that's net boot paid. Net boot paid does not enter into the recognition of gain. All right, but it does enter into the basis of the new asset. All right, Paul, does that make it any clearer? Okay, good. All right, now let's move on here, and we're going to go to something you probably have never seen before. It is 3A16.
Before we jump to that, can you give one last definition of net boot paid?
All right, with the mortgages? with the mortgages?
They didn't specify with mortgage. Let's see. Yes, with mortgages net.
Okay. If someone assumes your mortgage and it's $30,000 and you take on a new mortgage of $16,000, all right? Let's see what we have here. All right. If you put it down on a pad, of which, here it is. All right. There we go. Someone assumes my mortgage. If someone assumes your mortgage, that's boot received. All right. I forgot the number I used. Let's use 19,000 now. Now, I take on the other person's mortgage. That's boot paid. And that mortgage I'm picking up is 15,000. All right. Now, I net the mortgages. 19 is boot received. All right. 15 is boot paid. All right. If I net them, do I have a net boot received or net boot paid? And the answer is I have a net boot received of $4,000. Now, if I also receive some cash, say of $3,000 on the like-kind exchange, then my total boot received would be the cash of $3,000 plus the netting of the mortgages, which is boot received. My total boot received is $7,000. But we'll take the opposite here. All right. If the boot received on the mortgages, someone assumes your mortgage, all right, that's boot received of $15,000, and you take on a new mortgage of 19, that's boot paid. All right. What happens? You net the mortgages and it's net boot paid. Net boot paid for mortgages do not reduce your gain. It doesn't enter into the recognition of the recognized gain. Okay? I hope that makes it a little simpler. All right. Now, let us move on here. All right. Here we go. You're all going to get a headache from this one. All right. I have to do it. 3A16. 3A16. All right. 3A16. All right. Now, first of all,
Are we
right,
going to installment sales, or do you want this?
yes,
section
installment.
291?
All
Okay.
right. All right. Thank you, Cynthia. Cynthia had the question. She's saying much better.
Yep.
Okay, good. All right. That's probably the hardest part of this that people don't understand. All right, now let's talk about an installment sale. All right. Analyze an agreement of sale of an asset, determine whether it qualifies for installment sale treatment, federal income tax purposes. Anytime they say the word analyze, all right, that means this could be a what? It could be a simulation. All right. Now, what you're going to do is they may say to you, does this sale of its asset, by looking at the agreement, all right, qualify for installment sale treatment? Now it says an installment sale is the sale of property results in a gain, not loss. So therefore, when you have an installment sale, all right, you don't recognize a loss, you recognize a gain. All right, where a taxpayer receives at least one payment after the tax year of the sale, the character of the original gain could be capital or ordinary, and it remains unchanged by this treatment. Installment sale rules apply automatically unless the taxpayer elects adding installment sale treatment. Once made, the election can only be revoked with the IRS approval. All right, so I could sell on an installment basis, all right, for example, a capital asset. I sell my piece of jewelry, my personal jewelry, that's a capital asset, all right? Now, I sell a piece of equipment that's used in a trade or business, all right? That could be a Section 1231 asset if the equipment was held for more than 12 months, all right? If it's 12 months or less, it would just be an ordinary gain, all right? Now, here's our transactions not covered. A sale resulting in a loss. Property held for sale in the ordinary course of business. Inventory. You cannot sell inventory on an installment basis. You can't have an installment sale that results in a loss, because if it's a loss, you recognize all the loss immediately. All right. Now, number 3, the sale of your stock or securities traded on an established securities market does not qualify for installment basis. So if I have 1,000 shares of IBM, all right, and I sell them at a gain, all right, I cannot recognize a gain on the installment basis because the sale of securities or stock traded on established exchange does not qualify for installment basis. All right, now let's go to the next thing here. All right, if you move down, all right, it says here, calculate the amount of the gain on an installment sale for federal income tax purposes. All right, now let's read this. Gains and losses are generally recognized in the year of the exchange under the accrual basis. And we're talking about for tax purposes. For tax purposes, installment sales are an exception for gain reporting only. Let me repeat what I just said here. I mean, gains and losses are generally recognized in the year of exchange under the accrual basis. That means accounting. All right, but for tax purposes, installment sales are an exception for gain reporting only. Losses are always recognized on an installment sale in the year of the sale. All right, now, if the proceeds received are over more than one tax year, then the gain is recognized proportionally based upon the gross profit divided by the total contract price. I don't know what happened there. There we go. All right, and I'll show you what this all means in a second. So let me repeat that. All right. Under the installment sale, you're going to take your payments. Now remember, it's only principal payments. So if you receive interest, all right, or you pay interest, that has nothing to do with installment basis. It's only the principal that is actually subject to the installment basis rules. Now, if the installment sale has interest income to the seller, the interest income is recognized as income in full during the year and not multiplied by the gross profit percentage. The installment sales method cannot be used for the sale of inventory or the sale of stock or securities traded on National Stock Exchange. All right, now, how do you recognize the annual gain on the installment sale? All right, well, you take the gross profit. Gross profit is net sales minus cost of goods sold. That's gross profit. You divide that by the contract price. I'll explain to you what that is in a second. And you multiply that by the amount received for the year. That's only the principal payment received. All right, now let's go to page 3A17, please. All right, now let's look at some terminology here. All right, installment sale terms. The contract price, you gotta remember this. It's the selling price minus the seller's liabilities assumed by the buyer. Let me go over this with you. All right, you got to take the gross profit over the contract price. Now that is different from, accounting installment sales. This is tax installment sales. So what you're going to do is this. You're going to take the gross profit over the contract price. What's the contract price? The selling price minus any liabilities of the seller assumed by the buyer. All right. And the liability assumed by the buyer cannot exceed the seller's basis in the property. Don't worry about that. The gross profit on installment sales, all right, is installment sales minus cost of installment sales. All right. The adjusted basis of property sold equals cost minus depreciation taken. All right. And then let's see what else you have here. Gross profit percentage is gross profit divided by the contract price. The annual taxable profit is the annual payment times the gross profit percentage, and selling expenses include legal fees and commissions. All right, now let's look at the calculation here. And I'd like to go down to, if you would, all right, go all the way down to the bottom of page 3A17. All right, now this is where it's going to get tricky. All right, and for those who have left me, all right, if they ask this, you're going to say to yourself, you know, I heard that Phil YAEGER went over this, and you know, I would have gotten this right, all right, because it's not easy. All right, now let's see what we have here. Assume a corporation sells an apartment building placed in service in 1999 for $100,000 in cash and a $150,000 note due in 2 years. The corporation's cost of the property was $180,000 and had deducted depreciation of $130,000 based on the numbers given. The basis of the property is what? It is the $180,000 minus the $130,000 of $50,000. And the taxpayer recaptured $26,000, all right, as ordinary income, Section 291. Now, when there is recapture, that means that's the portion of the gain that's recognized as ordinary income. Now, do you know the recapture provisions? Well, let's go over this. All right. If you sell a Section 1231 asset, which is personal property used in a trade or business, all right, calculate the gain by taking the selling price minus the basis. All right. If the selling price exceeds the basis, you have a what? A realized gain. Now, how do you calculate the recognized gain? Well, the recognized gain, first you have to determine how much the recognized gain is ordinary. Now, if it's a Section 1231 asset, which means it's personal property used in a trade or business, all right, then what happens? The amount of the depreciation that you took is first recaptured as ordinary income under Section 1245. And then the balance is Section 1231 gain. Now, here's a good one, all right? Personal property used in a trade or business by a corporation or a sole proprietor, all right, is calculated the same way as far as the recapture. The amount of the gain where you take the depreciation that was taken on that property, all right, the personal property, that is ordinary income under Section 1245. The balance of the gain is Section 1231 gain under long-term capital gain. Now, let's look at here. We have a corporation that sells an apartment building. All right. Now, is there any recapture when a corporation sells real estate, all right, that was placed in service in 1999? First of all, anytime you have real estate which was held for more than 1 year, trade or business, it's considered a Section 1231 asset. However, you have to recapture some of that gain first as ordinary income. All right. Now, what is the amount of ordinary income if a corporation sells real estate? And the answer is you take 20% of the depreciation taken. All right. And that's under Section 291. Let me repeat that. Section 291 says this: if a corporation sells a Section 1231 asset, part of the gain has to be ordinary income. All right. The recapture for a corporation selling real estate held for more than 1 year, all right, the recapture is you take 20% of the depreciation taken. All right. That is ordinary income under Section 291. The balance of the gain will be Section 1231 gain or long-term capital gain. All right. Now, what happens if a sole proprietor sold an apartment building? Well, if you have a sole proprietor who sells an apartment building, all right, which is held for more than 1 year, all of the gain is Section 1231 gain. All the gain is Section 1231 gain. There's no recapture if a sole proprietor sells real estate used in a trade or business held for more than 1 year. All the gain is 1231 gain. All right. All right. Now, I hope you're writing this down. I think we went over this stuff. All right. But, all right. Any questions on that point I just discussed, the recapture provisions? It's going to enter into this. All right. Any questions? I don't see any questions.
Nope, nothing's popping up yet.
All right. Now, this is what we have to do here. All right. We have to calculate the gross profit because remember, all right, we're going to find out that the amount you receive each period times the gross profit percentage, which is the gross profit over the total contract price. That's the amount of the principal payment we'll record as income this period. But there's going to be a little difference here. Now let's go up a little ways here so I can see the bottom here. All right. It says, all right, if you look at the facts, the selling price is $250. Now, where am I getting that from? All right. A corporation sold in 1999 for $100,000 in cash and a $150,000 note due in 2 years. Well, the total amount received is the cash plus the note, which is $250,000. Now, what is the corporation's basis of the property? It's the 180. Okay. All right. I have to say, all right. The questions, I don't mind answering these questions, okay? But, so, all right, let me just answer the question. All right, what's a Section 1231 gain? All right, first of all, that's the long-term capital gain portion of a what? Section 1231 asset, which is real estate or personal property used in a trade or business held for more than 1 year. 1245 is the recapture provisions of personal property used in a trade or business held for more than 1 year. And Section 1245 says the amount of the gain, that's ordinary income, Section 1245, all right, is the depreciation taken. And that's for all business entities, okay? All right, now, please ask questions that are relevant to what I'm going over right now, because I'm okay? All right, you got that, Paul? Good. All right, so let's go back here. All right, we have the selling price 250, base is 50, gross profit is 200,000. All right, let's move on here to the next thing. All right, now, it says here, okay, the first step is to calculate a new gross profit percentage. All right, now why is that? Because if you take the total gain, all right, was, all right, $200,000, right? $200,000. Now, you have to remember that, all right, you have to recognize the recapture provision immediately, all right? Okay. I'm just curious if you, I'm putting you on the spot. The person just asked the question. What course did you take, if I may ask? Now, I'm not going to mention your name. What course have you taken? Have you taken a course based on that question? You took our regulation course? Yes or no? Is that yes or no? I'm just, yes, okay. All right, well, all right, I forgot the question. What is the question?
Can you please repeat who captured 20% and who captured 100% of deprivation as ordinary income?
Okay, on real estate, corporations have to take 20% of the depreciation, all right? And that's ordinary income of the total gain, all right? If a non-corporation sells real estate, there is no recapture, which means all the gain is Section 1231 gain, long-term capital gain, okay? All right, now, let's see what we have here, all right? We determined the amount of the recapture was what, all right? Can we go back to the top here again? Oh, wait, don't stop. Take the video. Okay. All right. The amount of ordinary income recapture was 26,000. All right. Let me show you where that comes from. Go back to the prior page a second.
Yep. Here, let me do that, minimizing the pages so that maybe we can get all of this on the same page.
Good. Okay. Now, if we look at the facts, it says, all right, let's see. The depreciation taken was how much on this property? All right. 130,000, third line from the top under the example. We take 20% of the 130,000, and that is what? 26,000. So 26,000 of the gain, all right, is going to be recaptured as ordinary income, okay? You always recapture the gain first. So what you do is you just say, all right, 20% of the depreciation taken, 20% of 130 is what? Ordinary income under Section 291. All right. Now, what you then do is, now let's go to the next thing. All right. The first step when you recapture is this. You have to calculate a new gross profit percentage. All right. Now, the selling price is still 250,000. The old basis was 50,000. All right. To that, we're going to add the recaptured amount as ordinary income. The recaptured amount was 26,000. Our old basis is now the 50,000 plus the amount we recaptured as ordinary income, 76,000. All right. Can we move up now, Carrie?
Yep.
All right. Now, notice our new gross profit is the selling price of 250. All right, minus the 76,000. All right, let's leave that minimized a second. I think it makes it easier if we can. Thank you. All right, we got the 250,000 selling price, all right, minus our new basis. That's the 50,000 old basis plus the 26,000 of recaptured ordinary income. Now we have a gross profit of 174. Now we take the gross profit, all right, which is 174, and divide by the contract price. Well, the contract price would be the selling price minus any debts the buyer assumes of the seller. Well, if you looked at the question, there were no debts the buyer assumed of the seller. So therefore, the contract price is the selling price. So now our gross profit percentage is 174 over the contract price, which happens to be the selling price of 250,000. All right. Now, the next step is to calculate the recognized gain from the cash collected. All right. Now, how do you do that? In year one, how much did we collect? $100,000. Remember that? All right. And to determine how much of that is profit, you take 69.6%. That's our gross profit percentage of the sale. And we're going to recognize $69,600 of the $100,000 gain. Now, how much is the total gain for the year? It's the section 291 recapture of 26,000, right? Plus, all right, the 69.6 recognized gain, that should be recognized gain, which means our total gain for the first year is 95.6. Okay? All right, now, let's look at the next 2 years. All right, now, the cash collected in 2 years. All right, if you go back to the facts, and I'll just read it to you, you don't have to go back to it. All right, let me show you where you're getting to 150. It says that in 2 years, they're going to collect a note of 150. Well, this is the second year. So they're going to collect a note of 150. Of that amount collected, how much is profit? 69.6%. So they're going to recognize in year 2, 104,400. Now, why are we not going to add to that the amount of the profit that was recaptured as ordinary income? Because we added that just to the first year. Don't add it again. You'll be recognizing it twice. And now let's look at the reconciliation of total profit from the installment sale. All right. Now, all right, you recognize 75,000 in the first year. All right. Why did you recognize 75,000 in the first year? All right. I don't know where you got the 75,000. On the note. You mean the $150,000 note? All right. The $150,000 note is due when? 2 years. So the first year, they're not going to collect any of that note. You see that? Deanna? Okay, good. All right, so let's do a reconciliation here. See if we're all right. Now remember, the original selling price was what? $250. Our old basis was what? $50,000. So we had a gross profit from the installment sale of $200,000. Now let's see if that equaled. The total gain we recognized in the first year was $95,600. The total gain we recognized in the second year was $104,400. We add them together, and that equals the total what? The selling price of $200,000. Did I get that right? All right. Does that equal? Did I reconcile it?
Yep, that
You see that?
that works. Mm-hmm.
All right. All right. Now, do they give this on the exam? And the answer is yes, they do. They gave this as a task-based simulation about 2 years ago. And I'm going to tell you something. They blew everyone out of the, well, I can't say that. It wasn't at every location. But a lot of people said, because I read the forums, hey, where'd they come up with this stuff? Well, it's right here. Calculate the amount of gain for federal income tax basis. Now, if you go and analyze in any textbook what's under this for tax purposes is you have to take into account if there's recapture. So here's the steps, all right? You take the selling price. All right, let's go back. Let's take the steps one at a time. Can we go back to the first page? The first step, Okay. The first step is we'll take the 250,000 minus the old base of 50. We have to recognize the total gross profit of 200,000. However, first we have to determine how much of 200,000 will be recaptured as ordinary income the first year. And the answer is, it's what? 20% of the depreciation taken, right? And 20% of the depreciation taken was how much? The depreciation taken was 130,000. 20% of that is what? Go to the next page, Carrie. All right, $26,000. Now, once you determine the depreciation taken, all right, you're actually going to calculate a new gross profit percentage. All right, now we take the selling price, which is still 250. That's the 100 plus the 150 notes. All right, now the new basis is this. It's the old basis of the 50,000. Add to that the gain recaptured as ordinary income. Now we calculate a new gross profit percentage. Gross profit divided by 250,000 equals 69.6%. All right, now what do we do? All right, let's see how much we recognize in gain the first year. Well, first of all, we recaptured of the gain ordinary income of what? All right, $26,000. All right, and then we have to do this. How much cash did we get in year one? 100,000 times our gross profit percentage of 69.6% gives you $69,600. All right, and total gain 95.6. We recaptured the gain already in year one. That's what you're required to do. Now in year two, how much did they actually collect in principal payments? All right, they collected the $150,000 note times the 0.696. The recognized gross profit in year two is 104,400. All right, and if you add the two together, 95.6 and the 104,400, then the total gross profit you earned for the 2 years is what? 200,000. Yeah, recapture is just another term for how much you're going to treat of the gain as ordinary income. That's what it is. All right, and we have different recapture provisions. All right, and there's only really two of them. There's section 1245. That's the amount of the ordinary income for personal property used in a trade or business held more than 1 year. And what is the amount of gain that's recaptured as ordinary income? The depreciation taken on that asset. Then you subtract that depreciation, which is section 1245, ordinary income, from the total gain. The balance is section 1231 gain, long-term capital gain. All right, now, what happens if that's a sole proprietor selling personal property or a corporation selling personal property? The rules are the same for the recapture and the balance of the gain. The only difference is for real estate used in a trade or business held for more than 1 year. If a corporation sells real estate, all right, remember, it's got to be real estate held for more than 1 year in a trade or business, all right? If you don't have that, you don't recapture any of the depreciation as ordinary income. Section 291 only applies to real estate used in a trade or business held for more than 1 year. If it's not more than 1 year and is a gain, all the gain is ordinary income. All right? So the 20% of the depreciation taken is when a corporation sells real estate. If a non-corporation, like a sole proprietor, sells real estate, all of the gain is section 1231 gain. 1231 gain is long-term capital gain. All right. I am sorry. This is not easy. I'm not. All right. Now, if you want to practice, I hope you will. All right. If you go down a little way, see multiple choice, do 24 through 35. All right. And I've covered that. Okay. All right. Now, since they're all blown, oh my God. All right. How many people are ready to shoot me? No, I'm just, all right. 39. I went up to 39 when I said, who wants to shoot me? Someone joined in. Now, this is not easy concepts. All right. It's not meant to be easy. All right. But, you know, you don't know when they're going to ask it. You could go by the odds and say, hey, they might not ask it, all right? That's like playing what we call Russian roulette. You know what that means? All right. You put all the bullets in a gun except for one. All right. You keep clicking the gun. All right. As long as there's no what? What does that say from Jennifer?
She's laughing out loud.
Lots of luck.
No,
Jennifer,
laugh out loud.
Okay. Jennifer, what question might you have for me that I can help you with? Can I help you? You know what, Jennifer? Please do this. All right. Call me. That's the easiest way. Call me. All right. Please call me tomorrow. Okay. 301-874-4900. All right. Extension 5. And I'll go over with you one-on-one, and maybe it'll be easier. Okay. All right. Will you give them my calendar link?
Yeah, we will send out, when we send out a follow-up email, we'll make sure to include that.
All right. All right. Now, don't leave me because the rest of it isn't that bad. I promise you. Okay? All right. The next thing we'll go over is related party transactions. All right. Do we need to take a 5-minute break? I don't know how you get the answer for that. All right. No. I like Grant Cohn. Oh, Grant. Yes, we spoke, didn't we? Let's keep going. Okay, no problem. All right. Hey, one person, Grant Cohn. I think Grant lives, I forget where he told me. He might live in California or something. And you from New York? Are you still in New York, Grant? Do you live in New York? Yes. All right. Yeah, we were talking about Long Island, if I remember correctly, right? Yes. Okay. Isn't this great? I'm talking, the other person is showing yes or no. Okay. All right. All right. By the way, here is a sip. Good luck to you. Let's just go on until 2. Okay. All right. Now, let's talk about related party transactions. All right. Now, let's assume we have this. All right. Take a piece of paper. All right. We have, with my piece of paper here. How can I lose my, oh, here it is. Okay, here we go. Related party transaction. All right. All right. A father sells to his daughter, all right, an asset having a selling price of $200,000 and a basis of $250,000. All right. Now, first of all, when a father sells to a daughter, all right, that's a related party transaction. Also, all right, if you have, it's got to be close relatives. Normally, a father to a cousin is not related party. Probably a father to a daughter, all right, a mother to a daughter, whatever. Mother to the father, these are all related party transactions. Now, remember this. If a related party, who is the father here, sells an asset to the daughter at a loss, the loss is disallowed. All right. Now we have a selling price of $200,000, and we have a basis of $250,000. We have a loss of how much? $250,000. That's real. I'm sorry, a loss of $50,000, and that loss is disallowed. All right. Why? Related party. Now let's assume the daughter sells it to a non-related party. All right. The daughter sells it to a non-related party for $300,000. That's the selling price. Now, what's the daughter's basis in the property she received from the father? Well, the father sold it to her for $200,000, so that becomes the daughter's basis. So the daughter's basis is $200,000. Now, there is a gain to the daughter of $100,000. However, the daughter can use the disallowed loss that the father had by selling the father to the daughter. All right. So therefore, the disallowed loss to the father was 50. The daughter's gain is 100. We can take the disallowed loss of 50,000 and reduce the gain of 100,000. So the daughter will only have a gain of $50,000. $50,000. Okay. Now, remember, related party transactions also include, all right, if you would, let me see here. Okay. All right. Related party all right, on page 3A19. All right, 3A19. Here's all the different related parties, okay? All right, let me tell you the important ones. Members of a family, brothers, sisters, spouses, okay? A transaction between a corporation and an individual that owns more than 50% of stock of the corporation, either directly or indirectly. Now, what does that mean? All right, if we have a stockholder who owns more than 50% of the stock of the corporation directly, and that individual sells an asset to the corporation, a loss, the loss is disallowed. Now, what happens if the corporation sells it to the more than 50% shareholder? The corporation will disallow the loss. Now, notice it says directly or indirectly. All right, now, what would be directly and indirectly? We have the following. All right, we have a husband who owns 50% of the stock and a wife who owns 50% of the stock. All right, and they sell it to a corporation. It could be an S Corp or C Corp. All right, and what's the transaction? Once again, the selling price is $350,000, basis of $400,000. So there's a loss of $50,000. All right, now it says here, if the husband sells it to the corporation, the husband owns directly 50%. All right, but because he sold it with, and he's married to his wife, all right, you can take this. H owns directly 50% and constructively, all right, or indirectly another 50%. So what do you do to see if it's more than 50%? You add the husband's 50% to the wife, all right, that's 100%. So you can say the husband owns 50% of the stock directly and indirectly to his wife, another 50% or 100%. So therefore, if the husband sells the asset at a loss of $50,000 to the corporation, the loss is disallowed. Now, let's assume the corporation sells it for $320,000, all right? And the basis is $350,000. That's what the selling price was from the husband to the corporation. So the corporation sells it to a non-related party. All right, 320. Basis is 350. All right, the corporation has a loss of, all right, $30,000. Now, can you tack on the disallowed loss of $50,000 that the husband had by selling it to the corporation, all right, to the $30,000 loss that the corporation had by selling it to a non-related party? And the answer is no, all right? The corporation can only recognize $30,000. What happens to the disallowed loss of $50,000? It is gone. It is gone, okay? All right, now, going back to the book, look at, this is another one. All right, sorry I joined late.
Phil, we can just keep moving.
Yeah.
Yep.
Everything I'm doing here is basis, okay? Everything, all right? Basis is throughout. That's why I picked all these areas. They're all basis. All right, now, once again, remember this. You can take a disallowed loss against a gain, all right, where the related party sold it to a non-related party. But you only can use the disallowed loss up to the gain. But notice the the corporation sold it to a non-related party of $30,000. The $50,000 disallowed loss is gone forever. All right. Now, also, this is also what they ask for related party. If you go down to number 10, a transaction between a partnership and a partner who owns directly or indirectly more than a 50% interest in the partnership. All right. Now, what do we mean by that? All right. Once again, we have A and B. They are brother and sister. And they own a partnership, each owning a 50% interest in the partnership. All right. They sell it, all right, to the partnership. All right. So we got A, the 50% partner, who's the brother, B, who's the 50% partner, who's the sister, who sells an asset to the partnership at a loss. All right. Now, let's take the loss here. Take the same numbers. Selling price, $350. Basis, $400,000. All right. So A, who sells it to the partnership, has a loss of $50,000, which is disallowed. Why? Because it's a related party transaction. The related party is A to the partnership. Now, why is A a related party? Because A owns directly, that's the brother, A is the brother, A owns directly 50%, and indirectly through his sister, when it's a relative, all right, he really owns that other 50%. So what you do is you add the direct 50% and the indirect 50% of the sister. A owns directly and indirectly 100%. All right. Now, that comes under, all right, the constructive ownership of stock. All right. If you go down a little ways, all right. All right. Calculate the direct and indirect ownership percentages of a corporation stock or partnership interest to determine whether they're related parties. Now, let's just look at the thing we just had here. We had the brother who owned directly 50% of the partnership, right? Indirectly, A owns 50% of C's interest, right? Now, if we take the B's interest, B owns 50% directly of the partnership, and B owns indirectly the other 50% of A, all right? That's considered the constructive ownership rules, all right? All right, so that's related party transactions. All right, let's move on here. And we'll go to page contributions to a corporation. All right, turn to page 5C, as in Charles, 5C, 13. C13. All right, give me a break. Give me a second here. I always say, give me a break. Okay, now. All right. Now, we're going to show here, this is on page 5C13. Okay? What this says is calculate the tax gain or loss realized and recognized by both shareholders and the corporation on a contribution. All right? All right. Now, remember this. From the shareholder's perspective, when acquiring corporate stock in exchange for property, the determination is if the purchaser should recognize a gain or loss depending on how much of the corporation stock he owns after the transfer. All right, so this is where we get into section 351 transfer. And what it basically says is this. If a purchaser, all right, transfers in property, only property, not cash. If a purchaser transfers in property, all right, and gets 80% or more of the stock of that company, that could be preferred, common, 80% of all classes of stock, then that's a tax-free exchange. Let me repeat that, all right? It says, all right, if a purchaser, all right, transfers in property at the time of incorporation, all right, and gets a 80% or more interest in the corporation stock, all classes, then the transfer is tax-free, all right? Now, that's exactly what it says on A, all right, the second subpoint. The taxpayer or taxpayers who contributed property acquire at least 80% of the corporation stock, and immediately after the transfer, they have control. And remember, in taxation, control is defined as owning 80% of the voting and non-voting stock. That would be the common and preferred stock, all right? So let's assume I have a piece of property, all right, which is $20,000 basis to me. It has a basis to me of $20,000, all right? Now, I transfer that in to the corporation. It's the initial transfer, all right? And I get 80% or more of the stock. Now, what's going to happen, all right? There will be no taxable event to me, the stockholder, or to the corporation. All right. Now, I believe, all right, let me make sure I get, all right, let me write the number down. If the basis of the property is 20,000 and I get 80% or more of the stock, then what happens? All right. There is no recognized gain to me who's transferring the property into the corporation, all right, for the stock or to the corporation. Now the question is this: if the property is being transferred in to the corporation and there's no taxable event, it's what? A transferred basis. So if my basis of the property is 20,000, all right, then the basis of the property to the corporation is $20,000. All right. Now, that's called control. Now, remember, at the time you incorporate, you could have more than one stockholder. But if you have, say, 4 stockholders, all right, they will not have, if they each contribute property, all right, they will not have a taxable event if all of those stockholders at the time of incorporation acquire 80% or more of the voting stock and non-voting stock, all right, no taxable event to the shareholders and to the corporation. And the basis of the property contributed by the shareholder to the corporation will be a transfer basis. So whatever the shareholder's basis was on the property becomes the basis to the corporation. Okay? All right, now let's go on here. All right, and it says, let me see, from the shareholder's perspective, all right, I'm on page 5C13. Is that where we are?
Yes, that's where we are.
All right. All right, so I have contributions, purchaser is part of the control club. What's the control club? 80%. All right, now let's look at the second bullet here. The taxpayer, I'm going to repeat this again. The taxpayer who contributed property acquires at least 80% of the stock, and immediately after transfer, they have control. All right, then there's no taxable event. Now it says here, all right, to be eligible to defer gain or loss, only property can be contributed in the exchange for only stock, not boot. All right. Now, property does not include services. All right. Can you see that? Okay. Property does not include boot. Let me repeat that. All right. Property does not include services. Stock in this context is any equity interest in the corporation. All right. And all right, now I want to go, forget what I just read there. That was, all right, go down to the next page. All right. It says boot. Now remember, all right, if you acquire 80% or more of the stock, you're not going to have a taxable event, but there are exceptions. All right. Now it says here, all right, when, next to last paragraph on the bottom, when a taxpayer contributes property and receives boot in exchange, all right, to the corporate stock and gets control, gain but not loss should be recognized. So it says here, if boot is received, gain is recognized to the shareholder. It's the lower of the realized gain, all right? So what do you get the realized gain? You take the fair market value of the property you're transferring in minus its adjusted basis, that's the realized gain, or the fair market value of the boot received. Whichever is the lesser of the two is the recognized gain. All right. Now, let's see what it says here. Would you move on to the next thing? I'll show you examples in a second. All right. Let's move on to the next page, please. All right. Which would be page 5C14. Okay.
Right. The corporation's basis of property.
Right. All right.
Okay.
All right. Now, you went to, okay. All right. The corporation's basis of the property is always the transferor's adjusted basis, plus any gain recognized by the transferor. Now, if there is no gain recognized by the transferor, remember, you only have recognized gain if you receive some type of boot. All right? Now, boot is considered cash. It's also considered stock in another corporation, or if they give you a short-term note. Those are the forms of boot, which will create recognized gain. All right. Now, let's read what it says here. Debt assumption. When debt is assumed by a corporation as part of the shareholder's acquisition of stock for property, it is not considered boot when determining the shareholder's gain or loss if the liability is less than the property's adjusted basis. However, here's another rule, all right? If you transfer in property which has a debt and the corporation assumes the debt, all right, what happens? All right, you take this. If the liability assumed by the corporation assumes the basis of the property contributed, that is gain to the shareholder, all right? So gain can be caused by boot received, all right, and or, all right, if you transfer in property which has a debt assumed by the corporation which is greater than the basis of the property transferred in, all right? So notice, although an assumed liability that is less than the property's adjusted basis is not considered boot for purposes of gain recognition, it is factored into the calculation of the shareholder's basis and the corporation stock after the transfer. Now let's look at this example here. All right? Can you move that up a little ways, Carrie?
Yep.
All right. It says a taxpayer contributes a building worth $200,000 to a corporation in exchange for 100% of the corporation stock. All right. The taxpayer's adjusted base in building is 100. The property is subject to a $25,000 mortgage, which is assumed by the corporation. What gain does the taxpayer recognize? Well, first of all, the taxpayer contributed property, all right, and got 100% of the stock. He got control. However, all right, even though he got control and there's no taxable event for that, if the property transferred in has this, if the liability assumed by the corporation is greater than the property transferred, then what happens? All right, that shareholder will have a gain. All right, now the property is subject to a $25,000 mortgage, which is assumed by the corporation. The basis of the property transferred in was 100. Is the liability of 25,000 greater than the basis of the property of 100? And the answer is no. And it says here, because the liability is less than the adjusted basis of the property, no gain will be recognized on the transaction. The assumption of liability by the corporation is always boot received for calculating the shareholder's basis and the stock calculation, but not for gain recognition. All right? Now, please go up some more. Carrie? All right, here we go. Gain may be recognized in two circumstances if a corporation assumes a shareholder's debt. All right? Now, remember, even though you acquire 80% of the stock, all right, and you transfer in property, all right, you still may have gain. Now, what can actually cause gain to be recognized? First of all, if the property you're transferring in has a liability, and if the liability assumed by the corporation exceeds the total adjusted basis of property contributed, gain must be recognized by the shareholder as follows. All right, recognized gain equals the liability assumed by the corporation in excess of the basis of the transferred property. All right, now, all right, let me see here, circumstance one. Bear with me a second. I got so much stuff on this desk. All right, now let's go to the next thing, Carrie, 5C15. All right, now let's look at these two terrific examples. All right, it says, all right, a taxpayer contributes property to a corporation with a fair market value of $150 and a basis to the taxpayer of $75,000. A liability of $90 is attached to the property assumed by the corporation. The taxpayer owns 90% of the stock after the transfer. What's the taxpayer's recognized gain? Well, all right, we take the fact that he transferred in property, all right, and he got what? 90% of stock. He got control. So there's no gain there. But you have to check this. If the property transferred in has a liability, which is greater than the basis of the stock, all right, did I say right? Let me repeat that, I said that wrong. If a corporation assumes the liability of the property, which is greater than the basis of the property transferred, the shareholder will have a gain. Now let's see here, all right? The liability assumed by the corporation is how much? $90,000. The basis of the property transferred in was 75. Does the liability of 90 exceed the basis of property of 75? And the answer is what? Yes. So it says it, because the liability assumed by the corporation exceeds the shareholder's adjusted basis, the taxpayer will recognize a gain equal to the excess of debt over her adjusted basis in the transfer property of $15,000. Okay? All right. You want to know what the basis of the property is? The basis of the property, all right, we'll go over in a second. Okay? Just wait a second. All right? And I'll show you that. Taxpayer M contributes machinery with a base of 45, fair market value 65, associated debt of 55. All right? The corporation assumes the debt as part of the transfer. What gain must M recognize? All right. Well, the amount of the debt assumed by the corporation, right? All right, is $55,000, and that's greater than the basis of the property transferred in. So therefore, M will recognize a gain equal to the excess of 55 over 45. All right. Now let's go to circumstance number 2. It says, if the debt was not incurred by the shareholder, all right, forget that, you know what? This was put in, but really, they're not going to ask you circumstance 2. I promise you. All right. So let's go to, all right, a few examples on page 5C15. 5C15.
That's where we are.
You are?
16.
Okay. All right. I'm sorry. You're right. All right. So let's look at, no, I want 5C15. Is that what I'm on? All right,
Yeah,
go
that's
back up there.
those are the examples we just went over. The first were the circumstance 1 and then circumstance 2.
Okay. All right. And don't worry about a valid business purpose. They won't ask you that. I promise that. All right. So with that, all right. So we went over taxpayer and we did that. All right. Now let's go over the next thing. And the next thing is, all right, basis of the stock. Basis of the stock on page 5C16. All right. Now, here we go. All right. Someone asked me about this. Calculate an entity owner's basis in a C corporation stock for federal income tax purposes. All right. Don't worry about reconciling the beginning and ending stockholders' equity of a C. All right. Now, let's go over this. All right. The shareholders' basis in the corporate stock. All right. What is the shareholders' basis in the stock? And then we'll talk about what the corporation's basis is in the acquired property. All right. Now, it says this. It's on page 5C16. You have to remember this stuff. The shareholders' basis in the corporate stock equals the following. It's the basis of the property transferred into the corporation. All right. You can add any gain recognized by the shareholder. Now, when would you recognize gain? Well, one situation would be if the liability assumed by the corporation is greater than the basis of the property transferred in, that gain is recognized by the shareholder. It would increase the shareholder's basis in the stock, all right? And also, you subtract any boot received. Received are reduction, all right? And that includes liabilities assumed by the corporation. So therefore, gain is caused by excess of liabilities, all right, assumed by the corporation in excess of the base of the property, all right? That's where you get the gain. But also remember, the assumption of liabilities, all right, assumed by the corporation is a separate item, even though it's used for the recognition of the gain. The liabilities assumed by the corporation is what? Boot received, okay? That is boot received. All right, now, next thing, debt assumption. Let's go down here. Although an assumed liability that is less than the property's basis, all right, top of the page. Although an assumed liability is less than the property's basis, is not a gain to the shareholders, it is considered, the assumed liability is considered boot received the calculation of shareholders' basis. All right, here's an example. A taxpayer contributes a building worth $200,000 to a corporation in exchange for 100% of stock. All right, the taxpayer's basis in the building is $100,000. All right, the property is subject to a $25,000 mortgage, which is assumed by the corporation. What is the taxpayer's basis in the stock? Well, the first thing is, remember this, they acquired control, right? All right, so the basis of the property, all right, to the shareholder, to the corporation is equal to the base of the property transferred in. So therefore, please remember, the shareholder's basis in the stock is equal to the basis of the property transferred in. How much is the basis of the property transferred in? All right, $100,000. Now, there's no gain recognized here. Why? Because the mortgage which is being assumed by the corporation, $25,000, is not greater than the basis of property transferred in of 100. So there's no gain recognized. But remember, the corporation is assuming that $25,000 debt, and by itself, all right, if they assume a debt, that's boot received to the shareholder. All right, so the 100,000 plus 100 minus the boot received 25 equals the shareholder's basis in the stock. Okay, now Carrie, can we go down a little ways on this example here? A taxpayer contributes. Don't show them the answer if you can. All right.
You're talking about the second example?
Yeah, I'm trying to see. Well, they're going to see that now. Okay, now. All right. It says here, a taxpayer contributes property to a corporation, fair market value 150, adjusted basis to the shareholder of 75. A liability of 90 is attached to the property assumed by the corporation. The taxpayer owns 90% of the corporation stock after the transfer. What is the taxpayer's recognized gain, and what's the taxpayer's basis in the stock? Well, is there any recognized gain here? And the answer is, well, the liability assumed by the corporation is 90,000. The basis of the property, all right, transferred in is 75,000. If the liability assumed by the corporation is greater than the basis of the property, all right, you will have a recognized gain, the shareholder, of $15,000. And also the liability of 90, all right, which is boot received to the shareholder, will reduce the basis of the shareholder stock. All right, now let's go down and look at the basis of the stock. You go down a little ways on this. All right, now here it is. The basis of the stock is equal to the basis of the property transferred. How much is that? Well, the basis of the property transferred is 75,000. All right, the recognized gain steps up the basis always. So we had the recognized gain of 15. All right, and the boot received is a minus what? 90,000. The liability assumed by the corporation. So therefore, the answer is what? 0. Okay, does everyone see that? All right, now let's go to the bottom of page 5C17. All right, let's go to 5C17 on the bottom. All right, it says here, what is the corporation's basis in the acquired property? Someone asked me that earlier. When property is transferred to a corporation in exchange for corporate stock, the adjusted basis for the qualifying property is a carryover basis. All right, now, this is the corporation's basis. If I transfer in property, I'm the shareholder, which has a base of 50,000, the corporation's basis is 50,000. But if there's any gain recognized by me, the shareholder, I'm the transferor of the property to the corporation. Any gain recognized by the transferor, who's the new shareholder, increases the corporation's basis in the property. Okay? All right, now let's look at an example on page 5C18. All right, here we go. Let's see what it says here. All right, it says, taxpayer B contributes a building with a fair market value of 85,000 and adjusted base of 50. The taxpayer received 25,000 in cash and 60% of the corporate stock. Taxpayer A received the other 40%, so the 80% control test was met. All right, what's the corporation's basis in the building immediately after the transfer? All right, now what is it equal to? All right, remember, the corporation's basis in the building is equal to the taxpayer's basis, which is 50,000. Now, what's the recognized gain here? All right, recognized gain is either the excess of the liability over the base of the property. There's no liability here. But the taxpayer received boot. What's the boot? The answer is $25,000. All right. Now, the recognized gain is $25,000. Now, how do you calculate the recognized gain? All right. This is what's important. All right. First, all right, when you receive cash, to get the recognized gain, all right, you take the lesser of the realized gain. Now, the realized gain is the what? The fair market value of the property minus its basis of $50,000. All right, that's the realized gain. But the cash received is $25,000. All right, so the recognized gain is the lesser of the realized gain or the boot received of 25. There's your recognized gain of 25,000. All right. All right. Now, please make sure you understand how to do this. It's extremely important. I promise you, it's important. All right. What if you contribute something, but what? What if you contribute something, but don't get 80% ownership? Good question. All right. If you contribute property, all right, where you don't get 80% ownership, all right, you, the shareholder, is going to have a gain. And the gain will be the lesser of, all right, will be the lesser of. The gain will be the excess of the fair market value of the property transferred in minus the basis. That's your gain, all right? Let me repeat that, all right? If taxpayer B did not get the 80% control, taxpayer B's gain would be, all right, the excess of the fair market value over the adjusted basis of $50,000, all right? Forget the cash received, all right? So his gain would be $35,000. And then his basis in the stock, all right, would be the fair market value of the property contributed, or $85,000. You see that? Yes? When you don't have a gain, you always use basis. But when there's a gain, use fair market value, all right? How about on the corporate side? All right. Now, the corporate side, all right, the corporation's basis would be equal to what? The fair market value, all right, the fair market value of the property, all right, and you would not add the gain recognized, all right? So it would just be the fair, all right, the basis of the property to the corporation is the property's fair market value. Okay? Got that? All right. Now, what should we do, Carrie? We got 5 minutes. What is a good question for 5 minutes? Okay? There's really nothing to do for 5 minutes. All right. Now, I covered corporations. Now, let's go to page 5E6 a second. 5E is in Edward 6. All right, bottom of page 5E6. We're into partnerships, all right?
Are you talking about section C?
5 Edward 6.
Yeah, no, I'm on the right page, but I'm asking are you talking about
C,
the?
yeah, subpoint C, yes.
Okay.
Now, I've really not had time. I will go over the partnerships next time, all right? I promise that. You know, this is trying to teach taxes in a very short period of time. And as I've said before, a review course is supposed to be a review, all right? But here's a couple of words you might see on the exam. Calculate the outside and inside basis of a partnership interest, all right? That's asked on the exam, all right? Now, I wonder, how many people know what the difference is between outside basis and the inside basis, okay? All right, now, it says here, next paragraph, when a partner sells their interest to a partnership, the partner will compare the selling price of his interest to their basis in the partnership, which is known as the outside basis. If a partner does not keep track of their outside basis, the partner can use an alternative computation of their basis. All right, so a partner's outside basis is where the partner, all right, keeps track of what his basis is at all times. And the outside basis would be the partner's beginning basis, all right? Also, what increases basis? Any additional contributions of property. The basis of those would increase the partner's basis. Also, remember, if you haven't, all right, if a partner is personally liable for the debts of a partnership, not a corporation, if a partner is personally liable for the debts of the partnership, that's called recourse debt. The partner's share of the recourse debt is considered a contribution of capital. It increases his basis. Now, what else? All right, what reduces his basis? Well, first of all right, withdrawals of assets. Withdrawals of assets. If there's a distribution of assets to the partner, that's a reduction of his basis. Now, notice, all right, what I'm doing here is I'm keeping track of my basis. Now, what happens if the partnership has ordinary income of $60,000 and I'm a 50% partner? I have to increase my basis by 50% of the $60,000 or $30,000. If there's a partnership loss, you're going to take loss up to basis. I'll go over this next time. But that's outside basis is where you're keeping track of this. Now, what happens in a question? They don't give you any basis, all right? And the answer is they allow you to calculate an alternative basis. The alternative basis is this. It is your capital account, which is an accounting term, plus your share of the recourse debt. They will allow you, if you don't keep track of your outside basis, all right, you can take this as your basis, all right? It will be the balance in your capital account on the books, plus your share of recourse debt. That will be the basis you have in the partnership. Now, the inside basis, the last line here is this. The inside basis is defined as all contributed property, all right? And it's equal to the aggregate base of assets transferred in the partners to the partnership, all right? So basically, the inside basis is the partner's basis in the partnership assets, okay? All right? The inside basis is the basis, all right, that the partners have in the basis of the property transferred into the partnership, all right? So that has nothing to do with really calculating your basis. So when you sell an item, all right, really, you got to take the selling price minus your outside basis. And if you don't know your outside basis because you don't keep track of it, then you can use as a substitute your capital account from your books plus your share of recourse debt. What is recourse debt? That's debt which the partner is personally liable for. All right. Now, they also show non-recourse debt. Non-recourse debt is what? All right. A debt of the partnership which you're not personally liable for. And in a lot of cases, non-recourse debt is a debt that's secured by some type of asset. If it's secured by an asset, generally the partner is not personally liable. But remember, never add to your basis, all right, your share of non-recourse debt. It's only recourse debt, all right? That was a very quick explanation. You know, all right, is there any questions? Any questions? Any questions?
I don't think any more have come in, but perhaps this is still a good stopping point.
Yeah, let's stop. I mean, I just want you to please understand, okay? When you're studying, you know, I'm going over this. Of course, I was hoping that you would understand. A lot of the courses don't go into the depth that we go because you have to understand